Good day, fellow deal makers. Welcome to the Deal Scout. On today's show, we're going to have a conversation with an SEC attorney, a securities attorney, who's going to talk to us about the Reg D. Now, you might have been, learning about raising capital through our past shows, and we're going to unpack Regulation D. Mr. Tilden, welcome to the show.
Super. Nice to meet you. I'm very excited to be here.
Yeah, man. Good to see you. Where are you calling in from today?
I live in Raleigh, North Carolina. Now, I've got an office in Los Angeles and one in Washington, D.C. But the reality is my practice is national. I can live anywhere, so I choose to live here.
Very cool. So, what the heck is Regulation D? Let's just dive straight into, raising
Sure.
capital through Reg D.
Let's start first with what a security is. So, a security is really anytime somebody is looking to raise money and they're going to be having their investors take a passive role, more likely than not, it's going to be a security. And a security either needs to be registered with the SEC or fall under an exemption. One of those exemptions is Regulation D. So, Regulation D lets you raise an unlimited number of dollars from an unlimited number of accredited investors. Sometimes you can raise from non accredited investors, and sometimes you can advertise.
Yeah. Yeah, there's different in Reg D, there's different parts, right? So you could
Yep.
man, I'm trying to remember all the stuff that I learned back in the day from my books. But
No
there's
worries.
there's some that you could do general solicitation, and then there's some that you can't. Why don't you kind of give
Right.
us the breakdown of when you could talk about it publicly, like here on a
Yeah.
show, or when you can't?
Yeah. So really, there's three rules. One rule we don't use anymore. So Rule 504 is kind of clunky. It doesn't really work anymore, almost always. So we don't really use 504 ever. The two rules we do use are Rule 506B and Rule 506C. Rule 506C says, hey, you can raise an unlimited number of dollars. You can advertise it to your heart's content, put a billboard up on Main Street, but we need to make sure that every single one of those investors is an accredited investor. So we actually need to verify that they're accredited. Under 506B, we don't need to verify anybody's accredited. Accredited investors can self-certify. We can also let in 35 non-accredited investors in any 90-day period. But the big hitch is we can't advertise. So there can't be a general solicitation. We can't, I wouldn't put it up on Main Street. Really, you're going to be talking about it with the people that you know, with your people in your network. And you're going to be trying to expand your network so you can get as many of those kind of investors as you can.
So we got the 504, which really doesn't get used much. We got the
Yeah.
506B, 506C. This is very interesting, and I'd like for you to unpack this. Why do they have 35 spots for non-accredited investors in the 506C?
It's really just a limitation so that the SEC's main concern is fraud, right? So they want to make sure that the investing public is protected as much as possible. So the general idea is if the number didn't exist, right? There's a very easy way just to could just solicit kind of on the side and just bring in a whole bunch of people or do things that just are a little bit shady in order to get those investors in. So in order to put a gate in between there, the thought was, okay, let's have it be 35 non-accredited investors. It used to just be 35 and that's it. Now we have 35 in any 90-day period. So theoretically, it's a rolling 35 days. But theoretically, then if you had an offering for that you put together, say we're offering it for 181 days, you could have 70 investors now that are non-accredited.
Yeah. So how do you approach 506B, 506C? Like, how would you choose? Because one, you could general solicit. That's a great benefit. But then the other
Yep.
benefit is, 35 nons. So you might have
Yeah.
friends, family. How do you choose?
So really you think about where your investors are coming from. That's the best way to start. If I know I'm going to be able to raise all this money from my own network, I'm probably just going to choose 506B. I don't need to verify anybody's accredited. I don't have to worry about if they're, I don't have to like question people. I don't have to give any sort of verification requirements or anything. I just need to make sure that they're good investors and that they know what they're doing, but it just makes my life simpler. If I don't have those people, I don't think I'm going to be able to raise all the money. I don't have a choice. I got to go to 506C at that point. And so there I'll be advertising and marketing. And then you can also at the same time go from Rule 506B and then have it change into a 506C. So there is a mechanism that's there that where you can kind of get the best of both worlds. It's just once you cross the line and go into the 506C world, you're done with non-accredited investors. You're not doing that anymore.
Interesting. So you could start out maybe as a 506B, do their general solicitation. You're talking to
Mhm.
everybody about it, and people could come in and say, I'm an accredited investor. They're self-acclaiming. And then at
Mhm.
some point you go, okay, I think I tapped out the bigger market. Now let's move into 506C. Is that the thought?
The smaller market, right? So
The
I
small
can
one.
talk to all my network. I can market that, market to everybody I know. Once everybody's there, then suddenly it's like, okay, I don't know anybody anymore. So at that point, then it's what we do is we close off the 506B, make it look from all appearances that the fund is done, that it's raised all its money. We wait 30 days. And the reason we wait 30 days is because the SEC says after 30 days, we don't consider that it the same offer anymore. If you open up another offer, we're not going to do what we call integration. It's not going to be the same thing. So then we'll wait those 30 days. Then we'll file again with the SEC and say, okay, we're going to now do an offering under 506C, and where we technically have a new offering, but it may have the same terms, it may not.
who who is the Reg D beneficial to, right? So I've talked with thousands of people through the show and through the community, and some people might be raising money for their first startup. Some people are raising a fund for real estate acquisition. Some are raising Series A and beyond. Where does the Reg D, what's the sweet spot for them?
It's really anybody who's looking to raise money that's fairly simple. They're going to be getting returns that are generally, normal, not anything that's super, super speculative, just a good offering, right? So if it was something that was, hey, I need to market this to a bunch of people. I want my investors to be able to invest only $100. Right then, you're probably like thinking about regulation CF or regulation crowdfunding rather than regulation D, because suddenly now I can market to at a cost point where it will probably make sense to get in those $100 investors. The reason that people generally don't is because the fees are really high. So if you are doing a regulation CF offering, all the traffic, everything needs to go through what's called a registered portal. That portal is registered with FINRA, and all the traffic and all the transaction work needs to go through that portal, and they charge a lot. And because they're doing a fair amount of work, they're doing really all the bookkeeping and all that side.
So when it comes
So
to
yeah, go ahead.
no, no, finish your thought because I have some other questions about the Reg A, Reg
Yeah,
CF,
yeah.
then you have the Reg D.
Perfect. So yeah, on Reg A, on the other hand, is a really, is very good. It costs a fair amount of money and it takes a fair amount of time. Under Regulation A, you can raise up to $75 million in your offering, and you can actually bring in non-accredited investors. It's kind of considered like a mini IPO. It is reviewed by the SEC. So that's what takes it a lot longer, is because the SEC gets the filing, they make a review of it, they may ask for changes, and they're going to be asking probably for audited financials and a bunch of other things. And they will review it to make sure that it seems like something somebody would invest into and seems relatively on the safer side.
Yeah.
Then if it does, then great. It takes between 6 to 9 months to get a regulation A offering out there, and that's why generally some people choose not to do it. Fees are also higher just because you have a lot of attorney time, you have accountant time, and things like that.
So what's the main differences between a Reg CF and a Reg A plus?
Dollar amounts that you can raise. Reg A does not require that it goes through a registered portal. But because of the cost involved, most of the time, then you'll have somebody who's got a license, a broker dealer, who's making those offerings out there as the mechanism to put it out there. Rig CF is more like what you thought of as Kickstarter or things like that. In general, because it's this lower dollar amount, people are generally who you're going to be getting in, and the high cost of fees, they're probably not going to be getting the greatest returns. Generally, that's going to be just people who are doing something super speculative, less $5 million or less, you raise.
Yeah. So when looking at, the different levels to raise capital, like people always reach out and they go, "Hey, I'm raising money." And, the first question is, how do I approach this? So, do you have different, parameters where you're like, if you're this kind of group, you should raise it this way. If you're this kind of group, you should raise it, with these kind of groups. Is there
Yeah,
a rule of thumb that you know of?
I think it boils down to like a few questions. So, like, how much money are you trying to raise? So, if you're want to raise more than $5 million, suddenly we're not even talking about Reg CF anymore.
Hmm.
If you need to raise over 75 million, we're not talking about Reg A anymore either. So then it's going to be Reg D by default. So the second question is, okay, who do I need to market to, or how do I need to market? Am I marketing to my internal network? If so, you're going to do Reg D. It's faster, it's easier, it's not complicated. If you need to market it to accredited investors only, you're probably still going to do Reg D because it's cheaper and faster. If no, it's very important because of the business model to market to non-accredited investors. At that point, then we're thinking, okay, maybe it needs to be Reg CF, maybe it needs to be Reg A.
That's one of the best explanations. So when people ask me, "Josh, we're looking to raise some money," like I'm going to point them directly to what you
Perfect.
just said. It was so
Great.
clear and concise.
Good. I'm glad it happened.
Yeah. What about friends and family, right? So I got these, founders and they're like, "All right, I'm raising money, grandma threw in some money, uncle." Where does that fit in?
Yeah, it's a securities violation. So, and I don't, not a week goes by where I don't meet with somebody who has done this. But anytime, it's really anytime you're raising any amount of money from somebody who's taking a passive role, it is a security. If so, that raising $10 from grandma to invest in your startup, it's still a security when you've done that. Now, the odds of getting in trouble with it, especially in that scenario, are practically non-existent, right? So, and I don't think the SEC would ever prosecute something at that dollar amount and with that relationship.
Yeah.
But they could theoretically. These things come up most of the time when a lawsuit gets filed.
Mhm.
So that's at the point when the SEC will get notified because the plaintiff's attorney is going to say, "Hey, SEC, I think there's a problem here." Because if they can show that there's a securities violation, they just won, right? They don't need to do anything anymore. So now they just get to collect the fees. So that's kind of how it comes up.
Mhm.
Is it polices it that way? If it doesn't really come up in the context for the most part about what is the right regular, whether it's Reg D, Reg A, in the context of some other kind of dispute. Most of the time, it'll be a lawsuit.
Yeah, interesting. So, worked with hundreds of different startups and they'll come and they'll say, "Hey, I'm, raising money from friends and family." Now, if they're
Yeah.
looking at passive roles, passive investors, they're selling securities and that is a security violation from
Yeah.
your thoughts.
Exactly. And even so, even if it's almost any kind of structure under that. So if it's a loan, right, it still is probably a securities violation if they're taking on that role, unless they're a bank or a regular like lender. If the lending is part of their regular business, it's probably not a security.
Really?
And that comes from a Supreme Court case. They looked at it and certainly they said, banks definitely loans are not a security for a bank. But even these people who are hard money lenders, things like that, it's probably not a security because their whole business is focused on lending that money out. And they're super sophisticated too. So the level of concern of protecting them is very low. So that's, I mean, because of that fraud protection piece, that's the SEC's whole concern, right?
Mhm.
So if they're not really worried about the people who are, you're a hedge fund manager managing $60 billion. They could, you're smart enough, you know enough about this industry. You don't need the SEC's protection for fraud. What they're concerned about is people who are especially non-accredited investors. They may not have the sophistication in financial instruments that other people do, and we just need to make sure that they're protected. So that if you keep that sort of thought process in mind, that's what they're trying to do. It becomes a lot easier to see, oh, okay, so that's why it's a security, because we're just trying to make sure that your brother-in-law is protected. Because what if you weren't you and somebody else was raising this money and wanted to, run out of the country?
Interesting. So early days of big tech company, a buddy
Mm-hmm.
pitches in, there's a story that a buddy pitches in 30 grand and he gets, half of the company. The other
Mm-hmm.
person does all the work and then it turns into a multi-billion dollar company. Essentially, if that was a passive role, that's a security violation.
Would be, but then it's the guy who's got the 30, who's got the big ownership stake, who's the person who was lending the money, right? Who was giving the money, who was buying the security. They're not going to make a complaint about the securities violation, right? It's only
Yeah.
against the company that they care. If that person lost all their money, that's when they're going to file a lawsuit and say, "Hey, this was being marketed basically as a public security, not as a private offering, and it wasn't registered." And that's when they'll get in trouble.
Interesting. Yeah, people typically don't do lawsuits when their, pockets are getting filled with
No,
cash.
God, no. So,
Yeah. So I love this conversation because there's so many founders out there who are looking for someone like you, founders or fund managers, to answer some of these questions. And,
yeah,
typically people have to go, clock in and, spend a bunch of money before you get these answers, or they have to
yeah.
learn FINRA stuff. Let me ask you a question. What is an accredited investor?
Good question. Yeah. So an accredited investor is there's two tests. So there is the what we call the net wealth test, or there's an income test. So it can be either of them. It does not need to be both. So they need to either be have an income of $200,000 for the last 2 years and expect to make it in this year. That number is 300,000 if they're going to count their spouse's income. Or it falls under the net wealth test, which is $1 million of investable wealth that does not include the equity in the family residence.
Yeah, interesting. So let's just say I'm running a Reg D 506C, accredited only, and I meet you, and I'm like, I wonder if this guy's accredited. So the first thing I go, hey, I'd really like to talk about something. Are you accredited? Like, how do you approach this? Like, show me your bank account, show me your wallet, and you're like, dude, I just met you. Like, how do you approach that?
Yeah, well, most people, what they'll do is they'll put on their website or whatever they're doing in their marketing materials for accredited investors only. And it's not required that they put that on that material. It's helpful for them though, so that way they're not spending a lot of time talking to people who can't invest anyway.
Yeah.
So most of the time it's there. Most of the time in the pitch, it'll be something like this is open to accredited investors only, or something like that. And
Yeah.
then as you get more through the process, if it hasn't been asked, it'll be okay, now we need to do our verification that you're a status. The more you don't, it's certainly not it's like dating is placing is getting, fundraising. So it's not a first date question, but it should be on your profile, basically.
Yeah. Yeah. Now, I'm looking on your LinkedIn, and I think everybody listening in should go check out your LinkedIn. His contact information will be in the show notes. But it says the syndicators and fund managers attorney. What is a syndicator?
So a syndicator is somebody who puts these deals together. So people generally think of a syndication as raising money for a single asset. So it could be a company starting up. It could be for a piece of real estate. could be something, it's just typically they think of it as one asset, whereas a fund will be more than one asset. In reality, as a matter of law, it's really the same thing. Same rules apply, the same everything, and there's really no definition of fund or syndication in the code. It just it's the way most people think about it.
Copy that. So and this has happened a million times before I went and took the Series 79 and went through this whole
Mm-hmm.
process, because people would ask me, "Hey Josh, could you help us raise money? You've got this massive network, and don't worry, we'll pay you." And I'm like, "No, that doesn't sound right.
Yeah,
Like
no.
I don't think I could get paid without the
Yeah.
license." So that's why I went to get the license. What are the rules and the guidelines around that? Because that happens to me, or that happened to me all the freaking time.
Totally. Yeah. So somebody is not allowed to get paid if they don't have a license in order to do it. And so most of them, if you are doing any of the activities that a broker dealer that it was required, that's something that can't exist, right? You could do it, but you certainly can't get paid for it. So most of the time we're talking about performance fees. So that's kind of like if somebody's getting paid a percentage based on the amount of money they raise, that's performance fees, and that is always going to be, you need a license in order to do it. There are people that will market securities and put it out on the internet, build ad campaigns, things like that, and they charge a flat fee, or they charge an hourly fee or something like that. Totally legit. They can do it. Not a problem at all. You could hire a company and pay them $10,000 to put together a whole marketing campaign. So long as they're not like actively engaged with the prospects and basically getting paid a bonus based on how much money they bring in, totally legit. They can do it. Not a problem. There are, though, a lot of people out there that misunderstand finders and think that they can raise money without a license. And that's where trouble comes up. And it's trouble not only for the person raising the money, but it's problem for the person paying them the money, the sponsor. And ultimately, it's a problem for all the investors, too. What happens is that if there's a payment of a finder and there is a lawsuit and it gets found out that that's happening, suddenly the entire syndication, the entire fund falls apart. The whole thing is now completely voidable. It can get taken apart just instantly. The sponsor of that needs to pay back all of the money plus the lost opportunity cost to every single investor, like then, that minute. Or there are massive, massive, massive fees. Coming up with $10 million in a drop of a hat is a little tricky to do.
Mhm.
So really, really bad stuff happens. So it's definitely something you never want to get involved in. And just make sure that if you're licensed for it and you can raise money for it, absolutely great. Then you're already covered and you already know that you're covered. But if you're not and you're not sure that you're not, you probably can't raise money and get a performance fee.
Yeah, there are so many different ways that people try to work around that issue, that
Mm-hmm.
topic. And to me, I
Yeah,
never
I
even
know.
wanted to get close to it because it scares the bejesus out of me, right?
Yeah.
Because just
Well,
what
that's
that
what people
scenario you
mostly get in
described.
trouble for. Yeah, that's what they get in trouble for. Right.
Yeah.
So people are right now. I mean, I get every press release that the SEC files. So I know what every lawsuit and every complaint that goes out there is. And it's either, well, they did something illegal on the broker dealer side, or it's a finder issue right now. So it's they weren't licensed, they were pumping this, they weren't licensed, they were pumping this.
Mm.
Occasionally you see insider trading, but more often than not we see finders or other kind of broker dealer activities that were
Yeah.
not exciting.
Man, I love this. Do you mind if I ask a few more technical
No,
questions?
no, absolutely.
All right. I kind of put you on the spot. What are you going to say? No.
As long as
The
I don't have to do calculus or anything like that, we'll be okay.
Yeah, I'm amazed of your recall. I'm always nervous that people are gonna on my own show or another show that people are gonna ask me a technical question that I forgot the answer to. So I'm really amazed by your ability to recall.
I've done it a long time, so I probably have had to think about it a lot.
Yeah,
So,
I find this a lot. We're in this big seller tsunami, and this idea of like people buying and selling companies. And when we're selling companies, right? I'm a real estate broker under Florida real estate law. I could buy and sell businesses for other
sure,
people. Once it
sure,
hits a certain threshold, or if there's other investors, then you start to get into securities. I'm
yeah,
a Series 79 now, and I can do M&A. But there's a lot
yep,
of people out there scouting for businesses and helping with the mergers and acquisitions and getting paid finder's fees for that. How does
yeah.
that fall into the categories through, like what you've seen?
It doesn't really fall into too much of what I do. The certainly when it crosses that, and you need to be what do they call them, an ERA or something like that. That's when it starts becoming. If you're either offering investment related information and services to a company,
Okay.
or you are acting as like truly doing the merger and acquisition, making sure that that happens. I mean, really, what's going on there is you've got, a company maybe buying out another company. Well, certainly the company that's being bought out is probably going to have a security or a bunch of securities underneath it that are of major concern. And so we need to make sure the SEC needs to make sure, okay, those people know that are invested in this business, how are they going to be protected when this comes over? Because if they're going to be getting a piece of this new business, suddenly the security is changing. So the general concern is how do we make that happen in a safe way?
Yeah.
Fortunately, I don't do the M&A stuff, so
Yeah.
I say, okay, great. You need an M&A attorney, then they can definitely help.
Yeah, that's awesome. So, Tilden, how did you get into this industry? Like, what made you interested? Because you said you were doing this for a long time. Like, what brought you into this?
Well, I went to law school to develop real estate, and so that was the big goal. I so I was going to do a an assisted living facility made out of modular homes. That was my big idea. So started looking around and thought, okay, I don't know how to develop, and I don't know how to get money. So seemed I a lot of my people around me that seemed to be successful in this business were attorneys that were doing it, and it made sense to me that I would need that skill set in order to be able to do it. So I went to law school. I loved law school; it was great. And then suddenly found myself on the side of doing of litigation. So I really liked the adrenaline rush at the time of litigating, and that went away very quickly. So I litigated for 10 years. I had a really great client set, but nobody was happy and everybody was fighting all the time. All of my dealings had to do with property as the underlying thing, and I tended to gravitate towards faster moving cases rather than long lingering cases. So I did a lot of bankruptcy, divorce, partner disputes, things like that, things that went really quick, where real estate itself was the underlying asset, and that's what the dispute was about. After about 10 years, I was getting burnt out and did some brokerage on the commercial side and enjoyed it. But commercial brokerage is the brokerage part of it is a lot of selling without a huge amount of reward. And so wasn't totally enamored with it, but sometimes it was certainly more pleasant than litigating. I had a partner on that side who showed me a deal in Alabama, and he said, "Look at this deal." I looked at it and said, "Yeah, it's great." And he said, "Well, you should syndicate it. We can do it together." Okay, let's do it. And so I had to figure out how to do it, and it was a challenge even for me. And so we did that deal, was very successful, and did another deal and another deal, and I really liked that area of law. Everybody was always happy, and so I stopped I stopped litigating altogether and started only working with helping people, put these deals together in order to raise money.
Yeah, really nice work. So this is kind of the personal side. You were doing litigation and you were doing these kind of cases, and you said you started getting burnt out.
Oh yeah.
Uh, as a deal maker, what are some ways to identify if you're getting burnt out and maybe your world needs a little bit of a pivot?
Oh, good question. I mean, I for me it was just doing a huge amount. I mean, the amount of stress was huge.
Hmm.
I didn't like the I liked the people that I liked my clients, but I in litigation nobody's happy. And so the only people that were easy to work with was the other side. And I didn't like that kind of world because even my clients didn't like me. They didn't like calling me because then I'd have to charge them. And so I don't know, I guess to answer the question, it was sort of if you're not getting like excited about your work, I was working quite a bit of hours, but I hated it. I certainly didn't like it. And now I really do enjoy my work a ton. I love my clients. I hope love me. And then I like coming to work every day.
Mm.
So to me, that's kind of it. I like looking at deals. I like hearing new things. Whereas if you're stuck in the wrong place and you're burnt out, you don't want to hear anything new. You just kind of want to hide.
Yeah. So as you're doing this, I mean, you switch over from a role where you describe where you're not really loved much, right? Like people are bringing a litigator or these kind of attorneys, and one side is paying you and they don't want to call you every 5 minutes, and the other side really doesn't love you. How does that
No.
how does that do to your emotional side of the because I talked with a couple thousand deal makers, and I always want to know
Yeah,
the emotional side of deal making.
sure. Um, it changes. I mean, in that role, you're generally much more third party, right? So you're trying to solve a deal between two other people and trying to make something happen. And a lot of times it's you'll see what the best interest is and what the best solution is. And the other side's attorney most of the time will know, if they're good, and most of them are. They'll know what that solution is either. And then it's just how do we get somebody to agree to it? How do we get somebody to that see the best deal of everybody's mad and hates the deal, then it's pretty good. So how do we move everybody to that, so that way we can go on to the next matter and try and help somebody else when you are so it's a very destructive process because you're always trying to move things away from other people, and so the emotional
Mm.
side on the good, in syndication and everything is I think about, when I do my own deals, I think about me, I think about my investors, I think about the seller. And because if it goes happily, it's going to be a great deal for everybody.
Mm.
I have to take care of my investors, not only because it's the right thing, but also because they'll invest with me again and again. Right. So the more happy I make everybody, the better everybody is. And that's such a better world to live in
Mm.
than the destruction of, okay, how do we take this whole thing apart, um, so that we can go on to the next thing. Now it's like, okay, how can everybody make as much money as possible? And everybody wants to make a lot of money. So
Yeah. How has your life changed from making that pivot from burnt out in a role that you were just kind of getting sick out
I don't
to now?
know. I mean, it just is a it's completely different because I love what I do now, and there I didn't. So,
Yeah.
so I love coming to work. I'm, I love my family, and they're, the most important thing. But I think about work all the time, and it's never like it's not a weight on me. I'm always like, oh, wait, we could do that, rather than
Yeah.
uh, like, oh God, I don't want to go into work.
Yeah, I get it. What advice do you have for people interested in raising capital or who are getting into the industry?
Yeah.
What future advice do you have for them? Maybe not. I mean, you're an attorney. You know what to say and what you're not allowed to say.
Well, I mean, I was definitely thinking about doing it. There's a lot of resistance that is going to go on internally for anybody who's thinking about it. And it's mostly based on fear of how am I going to raise the money? How am I going to be able to pull this off? Am I good enough to do this massive deal and things like that? And the answer is that fear doesn't really go away much. But the number of people that I've helped that are successful and were having those same thoughts is really huge.
Hmm.
And the people, your listeners, are probably just as smart as all of them, and are quite capable of doing it. And it's really a matter of it's a well trodden path that that certainly can help make people successful. And if you have a choice, if things completely fail, like it just doesn't work, at the end of the day, there's very little bad stuff that happens to the sponsor, as long as you're not doing fraud or anything like that. So there's very little to actually lose in this business. And there's a whole bunch to gain. So really, it's kind of like, well, why not? Why wouldn't you just do it?
Yeah. From your experience in working with all the different syndicators and fund managers and people out there raising capital, what are some characteristics that you have seen in them that make the best?
Just drive. People who want it. So everyone who has been successful of my clients has been they were excited and wanted to do it. If I get somebody on the phone and it doesn't sound like they're really like personally driven. They probably are less likely to be successful. Um, it's just more a matter of getting out there doing it, wanting to do it, being creative, be willing to adapt, because it certainly no deal ever goes the way you think it's going to go ever. So it's always going to go weird and get at the last minute things are about to look like they're blowing up, and that's just the way it works. But if you want it enough, you keep going and you get through that, and it becomes good.
Tilden, you're phenomenal. What questions should I have asked you? I'll ask you in the end, like where people can connect you. But what
Okay.
questions should I have asked you about raising capital that maybe I screwed up and did not ask?
I don't think it was. I guess the question that I'll give you the answer to, I guess it's like, what's the most important thing in raising capital? And that is, I think, especially when talking with investors, is knowing what the story is. So investors invest based on emotions. They do not, this ideal of the rational investor is completely not true. It doesn't exist. Nobody makes decisions that way. People make decisions based on emotion, and then they check in with their rational side to make sure that it was okay that they did it. And that's about it. So every time you're talking with an investor, there needs to be some sort of story behind it. There needs to be something that's emotionally driven, in order for them to feel good enough to basically change their level of trust and invest with you. And so I would always connect with that. Like if I've got a hey, I've got business A and I've got business B, and I'm trying to sell them both. And business A, well, is going to give you a 10% return, or let's make it a little bit better. So let's say a 25% return, on an IRR basis over 5 years. So that's just what our underwriting says. So I got 25%. But on this side, I've got this business that's going to change the world. It's going to change the way you think. It's probably going to pay you, 18%, but it's going to be amazing and you're going to be really proud of it. You're going to go for almost everybody's going to go for number B or letter B, because it's so much more compelling, right? It's like, oh, yeah, I can see that. It's just more exciting. The rest is just a number. And it kind of is hard to get excited about that.
Yeah,
That's my
fantastic.
big tip on how to talk to investors and raise money.
Man, I love that. And I've worked with a ton of different, people who are professional investors, and I think that they would agree. But I think my assumption would be that that would almost be like, I consider myself a smart investor, very logical, non-emotional driven.
Mhm.
But at the end of the day, if you ask them, they would say, yeah, I invest in things that I believe in, that I have a
Yeah.
natural affinity to, and that's emotional.
Yeah. Yeah. If it's not something that they find compelling, they're just not going to invest in it. You can talk to your blue in the face, and they just won't. And I tried, and that's how I realized that I was doing it completely wrong,
Yeah.
because it wasn't about the number at the end of the day.
Yeah, interesting. I got so many other questions for you, but we're out of time. Where
Cool.
can people go to connect with you and learn more?
Yeah. So my website, moschettilaw.com. I've also got a YouTube channel with a whole bunch of videos that walks through kind of everything that a syndication attorney would know. And some stuff about selling securities and finding investors and things like that. So YouTube's a great place. LinkedIn's great. Don't hesitate to reach out and give us a call.
Yeah, super cool. Fellow deal makers, as always, reach out to our guests and say thanks for being on the show. Their contact information will be in the show notes below, or you could always reach out to me and I'll connect you. If you have a deal that you'd like to talk about here on the Deal Scout, head on over to thedealscout.com, fill out a quick form, maybe get you on the show next. Till then, we'll talk to you all on the next episode. Cheers, everybody.